Hi, it's Peter Schiff. It's Friday, March 1st, 2013. And if you believe the hype of the Obama administration, it's the first day of the apocalypse because the itsy bitsy, teensy weeny, basically non existent cuts, otherwise known as the sequester, go into effect today. In fact, even Ben Bernanke chimed in during his 2-day testimony on Capitol Hill by warning both the House and the Senate of the dangers imposed by these itsy bitsy teeny weeny spending cuts. Of course, they refer to them as draconian, or maybe not Ben Bernanke, but that's what the media has been saying. But maybe they say sharp cuts. According to Ben Bernanke, maybe we ought to have a more gradual approach and have the spending cuts in the future. The problem is, if the spending cuts are in the future, they never take place. Remember, the sequester was about cuts in the future because they were proposed about a year and a half ago to take place in the future. So you can't trust Congress to keep promises to cut spending in the future. What you have to do is force them to cut spending now. The only real problem with this sequester is that the cuts aren't real. They're reductions in the rate of increase. What we need is far more substantial cuts, and we need them right now. And contrary to what Ben Bernanke advised Congress, big cuts in government spending won't stifle the economy. They'll unleash the economy, because when the government stops spending, the government returns resources back to the private sector. The government has to get the money from somewhere, and wherever it's taking it, it's undermining economic activity, and it's transferring those resources from the private sector, where they would be used productively, to the government, where they're used unproductively. I want to, though, focus on some other aspects of Ben Bernanke's testimony that should have received much more attention in the media and in the markets, but they didn't, so I will shine a light on it myself. First of all, the Fed, Ben Bernanke in particular, has been bluffing about his exit strategy since they first started QE. Back then, I kept saying that there is no exit strategy, that the Fed is bluffing. It's just going to get deeper and deeper. It's going to do more QEs. And I said that they checked into the Roach Motel of monetary policy, that they could check in, but they would never check out. And so far, that's precisely what's happened. They keep on doing more QE2, QE3, Operation Twist, QE Infinity, whatever you call what we got right now. But all the while, the Fed has pretended that somewhere in the distant future, there's an exit strategy that the Fed has in mind. Well, the Fed came the closest, or Ben Bernanke came as close as I've ever seen to acknowledging that he has no exit strategy. He's basically been bluffing, but now he's thrown his cards on the table, and we can see that he's holding nothing. He was asked in Congress what would happen to the economy when the Fed has to exit and start selling the mortgages or the treasuries that it's been buying. And not only the economy, what would happen to the Fed's own balance sheet? How much money would the Fed lose when it had to sell off these securities at a loss? And Ben Bernanke's answer didn't surprise me, but again, what does surprise me is the lack of reaction to it in the markets. Ben Bernanke admitted that he doesn't have to sell these securities. He basically said, we can simply hold the maturities until they mature, therefore we never have to sell them. Now, supposedly this means the Fed will never have a problem. Of course, Ben Bernanke is wrong. First of all, thanks to Operation Twist, the average maturity on the Fed's balance sheet is now pretty long. They've got a lot of bonds that don't mature for 10 to 30 years. Now, if, as Ben Bernanke has been saying, the Fed stands ready to fight inflation the minute it sees the whites of its eyes, how is it going to do that if it's going to take 10 to 30 years for its balance sheet to unwind? They just can't let these long-term bonds mature. They need to do something to tighten monetary policy immediately. And of course, the inference that if the debts mature, that it's not going to affect the market is nonsense. Because assuming the Fed allows its bonds to mature, and that'll be easier with short-term bonds, that doesn't mean that those bonds aren't going to crush the market. Because if the Federal Reserve doesn't roll over that debt, then the Treasury has to find an alternative buyer. So even if the Fed doesn't sell bonds, the Treasury is going to have to sell those bonds. What is that going to do to the market? And who's going to buy those bonds if the Fed's not in the game anymore? The Fed's the biggest buyer in the Treasury market. That's the same thing with the mortgage market. If the Fed isn't buying mortgages, what's going to happen to mortgage interest rates? What's going to happen to the housing market? What's going to happen to the banks? Now, of course, the other problem with what Ben Bernanke said is that he was trying to, dissuade the concerns that the Fed was going to lose money selling off these bonds at a loss, and that was going to cost the Treasury, which would have to make up the losses. So Ben Bernanke said, well, if we don't sell these bonds, we can also raise the interest rates that we pay banks on their excess reserves. Well, fine, but where's the money going to come from? That's going to produce an operating loss at the Fed. So one way or another, the Fed is going to lose a lot of money. Either they lose money by selling bonds into a depressed market or by paying interest on excess reserves. Either way, they're going to have to start sending a bill to the U.S. Treasury rather than a check, because right now the Federal Reserve is paying the Treasury income because it's earning income on the bonds that it's holding and on the mortgages that it's holding. But when it starts to lose money, either because it liquidates those securities at a loss or because it has to start paying high interest rates to the banks to try to tighten monetary policy without unloading those bonds at a loss, it's going to send a bill to the Treasury for its operating losses. But what this should show everybody is that, again, the Fed has no exit strategy. Yet the markets, for some reason, seem to shrug this off. I mean, it isn't a surprise to me that the Fed said that, but what's surprising is that it should have been a surprise to everybody else, but it wasn't. Another interesting admission that the Fed made came in response to a question regarding the apparent hypocrisy of what Ben Bernanke was saying. Ben Bernanke, during his testimony, is taking credit for rising home prices, saying it's the Fed's monetary policy that is responsible for the increase in home prices, which is helping the economy. But if you recall, the Fed claimed, the Fed abdicated any role or absolved itself of any role in inflating the real estate market during the housing bubble. Ben Bernanke claimed that the Fed's policies had no effect on home prices in 2004, 5, 6. But how can he now claim that the Fed's policy is causing home prices to rise? And a congressman from New Jersey pointed out the hypocrisy, and Ben Bernanke tried to undermine that argument by stating that, well, during the housing bubble, long-term interest rates, long-term mortgage rates were about 6%. They never got to these low levels, and therefore the Fed wasn't using interest rates to inflate the housing market. Well, of course, what Ben Bernanke conveniently overlooks is that it wasn't the 30-year fixed rate mortgage that was really the culprit. It was the adjustable rate mortgage. It was the teaser rate. That's really what fueled the bubble. It was the ability of people to buy homes they couldn't afford by relying on the temporarily low interest rates that resulted from adjustable rate mortgages or those teaser rates. And that was a direct consequence of the 1% Fed funds rate and a 1% discount rate by the Fed, and the fact that the Federal Reserve raised interest rates much too slowly, and so that enabled that adjustable rate mortgage market to get bigger and bigger and bigger. So the Fed influenced the housing market during the bubble predominantly by influencing the short end, making it easier for people to take out arms. Today, the Fed is influencing the housing market not predominantly by influencing adjustable rate mortgages, but by outright buying 30-year fixed rate mortgages to drive mortgage interest rates down to record lows. But in both cases, it was the Fed's interference that inflated the prices, inflated the bubbles, and there's going to be a disastrous consequence when this bubble bursts. Although this bubble is not going to be, I think, as large as the previous bubble, I think the consequences will be much bigger because the Fed is not going to succeed in elevating home prices, but what they are succeeding in doing is transferring significant percentages of bad mortgages from the private sector to the Federal Reserve. In fact, the federal government has never been more involved in the housing market than it is today. Not only does the government insure over 90% of the mortgages through the FHA, through Fannie and Freddie, but now the government owns the mortgages. The Federal Reserve is financing them. The Federal Reserve is buying $45 billion worth of mortgages every month. So the government is the housing market. And all of this all of these resources have been transferred via the government policy into the housing sector. We don't need to build more houses. Again, we need to build more factories. We need to make things. We don't need more houses. In fact, we can't even afford the houses that have already been built. The problem with the Fed is the Federal Reserve thinks that somehow, if they can just get this economy going with all this artificial stimulus, that they can remove these training wheels and the economy is just going to coast along on its own. Well, it's impossible. It's the stimulus, it's not the training wheels. They're the only wheels. You take those wheels away and the economy collapses. Ben Bernanke thinks he's building an economy that could sustain itself without the Fed. It's the opposite. Ben Bernanke is creating an economy that is completely dependent on the Fed. The U.S. economy needs artificially low interest rates. We have to go deeper and deeper into debt to sustain this. The government needs the Fed so that it can keep spending money that it doesn't collect in taxes, and it can't convince private lenders to finance. So in order to have this huge government spending, this huge Keynesian stimulus, the Fed has to monetize the debt. And to keep the housing bubble going or reflated, a lot of people think that housing is recovering. It's not recovering. Sure, prices are moving up a little bit because the whole foreclosure process is gummed up. There's a lot of people now, thanks to the government, that are refinancing their mortgages even though they're underwater. So that's also slowing down the foreclosures. And you got a lot of speculators that are taking cheap money that they get from the Fed and using it to buy up single-family homes on spec. They're going to put these homes up for rent. They're not real buyers there. But this whole phony recovery is completely dependent on the Federal Reserve. The Fed knows that. They can't take away the punch bowl without completely ending the party. So the Fed wants to pretend, but at least here in the most recent minutes, they let their guard down and kind of let it out of the bag that there's no way that they can unwind what they've done. When Ben Bernanke was asked specifically about monetizing the debt, and when he was accused of monetizing the debt, Ben Bernanke said, "I'm not monetizing the debt." And he said that because he said, well, that's because the Fed is going to sell it. So since we're not going to sell the debt, we're not really monetizing it. Well, now, in this testimony, he admits that he has no intention of selling the debt. Who's he kidding? Of course he's monetizing the debt. And you know what? Even if he holds the debt to maturity, if he lets the debt mature, where is the government going to find a new buyer for that debt? It's going to be the Fed. The Fed is going to be the only institution willing to buy because the Fed has an unlimited bank account because it can print money. So it doesn't care how much it loses because it's not losing its own money. So it'll be willing to buy these bonds. Again, I've said this time and time again, and I'll say it again. The only thing that's going to stop the madness, the only thing that's going to put a monkey wrench in Ben Bernanke's printing press, the only real exit strategy is the crisis. It's when the world wakes up to this con and we have a currency crisis, when the dollar collapses, when the bond market collapses, when the Fed can't prop up the bond market anymore because it can't keep printing money because nobody will take it. If the Fed is printing money that nobody wants, that doesn't buy anything, then it doesn't matter how much money the government can borrow because it doesn't do anybody any good when they get the checks. Right now, America benefits from the fact that there are problems all around the world, as the recent elections in Italy reminded us. And as people seek out refuge from other countries that have problems that are obvious, but really not as great as the problems in America, the end result is that money flows to America. It flows into our bond market, into our currency, making it easier for us to go deeper into debt, to borrow more money, to print more money, to inflate our phony economy to an even larger size, and yet the world doesn't care. With global stock markets rallying, particularly here in the U.S., the dollar strengthening a bit, gold selling off, gold stocks really selling off, market sentiment, investor sentiment is turning. They actually believe that the governments have turned this around. They actually believe that the Fed policy has worked, and somehow they still believe that Ben Bernanke is going to be able to withdraw the stimulus without toppling this house of cards that rests on the very foundation of that stimulus. But remember, These are the same geniuses that were fooled before, the same geniuses that were confident everything was going to be okay right up until the financial crisis of 2008. Remember, Ben Bernanke himself denied that there was a problem even after the problem should have been obvious. Even after the housing bubble burst, he still didn't recognize that it existed. Even after the subprime crisis, he said everything was contained. So if he couldn't see that crisis, it's no wonder that he can't see the next one, especially since the cause is the same. All of it has its roots in Fed monetary policy, yet Ben Bernanke still doesn't recognize that. Now, maybe he does, but like Jack Nicholson, he doesn't think the markets can handle the truth, or maybe he's just so incompetent that he doesn't recognize it himself. But either way, this is going to end badly. If you recall, President Clinton got out of Dodge before the stock market bubble actually burst. That didn't happen until George Bush came into office. He wasn't as lucky. He didn't get out of Dodge. The housing bubble that was created under his watch burst late in his second term. So if you notice, the windows are contracting. Now, President Obama, we've got a bigger bubble going on during his presidency, and he ain't getting out of Dodge either. Only this time, I think the bubble is going to burst not late in his second term, but early. And the difference is going to be there are no more bailouts. This is the last bubble. This is the biggest bubble. In my book, The Real Crash, I call it the government bubble. That's what we have. This is the final bubble, and there is no bailout. We're finally going to have to deal with the consequences of our profligacy. And the problem is because we've kicked the can down the road for so long, right? We've papered it over with so much inflation that the problems have gotten that much worse, which means when we finally are forced to confront them, and again, we're going to be forced to do it. We're not going to do it on our own. We're not going to voluntarily check into rehab. We're going to have to be forced to do it because we've hit rock bottom and the world has done an intervention. This day of reckoning is coming. And it's not because of the sequester. You know, everybody is making a big deal about how painful the sequester is supposed to be. Well, this is nothing compared to what's really going to happen when we really have to swallow this bitter-tasting medicine to restore health to an economy that is virtually going to be on its deathbed as a result of all the bad medicine that has been force-fed it over the years by the Federal Reserve, by Congress, to mask the symptoms while the underlying disease gets that much worse. That's all for now. I'll be back again with more updates. That is, of course, unless the sequester brings the internet to a complete standstill and I can no longer record these videos. Thank you.